All right, everyone, get ready, because today we are going deep on loans.
Loans.
Specifically, the difference between secured and unsecured loans.
Yes.
This is something that we all run into
Yeah.
at some point in our lives, whether we're talking about buying a car or buying a house or maybe consolidating debt. And,
Right.
getting this right
Uh-huh.
can really save you
Yeah.
a ton of headaches.
It really can. Understanding the mechanics of these two different types of loans is really crucial
It is.
for making smart borrowing decisions.
Absolutely.
We don't want you to just be signing on the dotted line
Right.
without having any idea what you're getting into.
We want you to be empowered
Exactly.
to make the best financial decisions for your situation.
Absolutely.
So let's start with what might seem like a simple question,
Okay.
but it's really at the heart of all of this.
Right.
What is
Yeah.
the difference
Yeah.
between a secured and an unsecured loan?
So the fundamental difference boils down to collateral. A secured loan requires you to pledge an asset,
Okay.
something you own, as a guarantee to the lender.
So it's almost like saying, hey, if I don't repay this loan, you can just take this thing to cover your losses,
Exactly.
and this thing is my collateral.
Yes, your collateral.
Okay, so think of it like your house is collateral
Right.
for your mortgage.
Uh-huh.
Your car is collateral for your car loan.
Exactly. And those are probably the most common examples that we encounter.
Right. A lot of us probably already know that even if we don't necessarily think of it in terms of secured loans,
Right.
we just know
Yeah.
that the bank could take my house
Yeah, exactly.
if I don't make my payments.
That's right.
But, collateral isn't limited to just houses and cars.
No, not at all.
It could be other things too.
A whole range of assets that you own.
Okay, and this is where it gets interesting for me, because in doing research for this deep dive,
Uh-huh.
we dug up some pretty surprising things that can be used as collateral. Did you know that you can sometimes use bank accounts, investments like stocks, even high-end collectibles as collateral?
That's right. It's true. It's not an everyday scenario.
Right.
But depending on the lender and the specifics of the loan,
Sure.
those items can be on the table.
Okay.
This really highlights that secured loans can take many forms.
Yeah.
And it's really vital to understand exactly what's at stake
Yeah.
before you commit.
Okay, so I'm starting to get a little nervous just thinking about it.
Okay.
What happens
Yeah.
if you can't make your payments on a secured loan?
Well, that's where the risk comes in.
Okay.
If you default on a secured loan, the lender has the legal right to seize your collateral,
Oh, wow.
to recoup their losses.
So if I can't make those mortgage payments, the bank could foreclose on my home.
Yes, exactly.
Wow.
And it's a tough reality.
It is a tough reality, and I think that it's worth underscoring how serious this is.
Mm.
A repossession stays on your credit report for 7 years.
7 years.
That's a long time to feel the sting
It is.
of a financial misstep.
That's right. And it's not just about the immediate loss of the asset itself.
Right.
It's about the long-term impact on your creditworthiness.
Yeah.
That repossession can make it much harder
Uh-huh.
to secure loans in the future.
Sure.
And if you do get approved, you'll likely face higher interest rates.
So the stakes are pretty high
It can be, yeah.
with secured loans.
Yeah.
But what about unsecured loans?
Okay.
Is it all sunshine and rainbows over there?
Well, not necessarily.
Okay.
With unsecured loans, you're not putting up any specific asset as collateral.
Right.
Instead, the lender is relying on your financial reputation.
Okay.
They're evaluating your creditworthiness
All right.
based on factors like your credit score, your payment history, and your debt-to-income ratio.
So it's like they're looking at you and they're saying, okay, is this person responsible?
Yes, exactly.
Can we trust them to repay this loan?
That's right.
It all comes down to trust.
Absolutely.
And I imagine that trust comes with a price tag.
It does, the interest rate.
Yeah, the interest rate, the cost of borrowing money,
That's right.
that's a big part of the equation.
Huge.
But before we even get into the nitty-gritty of interest rates,
Okay.
let's talk about some common types of unsecured loans.
Oh, right.
What are some of the ones that we're most likely to come across in our daily lives?
Well, you've got student loans, which many of us know and maybe love to hate.
Yeah.
Then there are personal loans, which
Okay.
are increasingly popular these days.
Mm.
And of course, we can't forget about credit cards,
Right.
which are essentially a revolving form of unsecured loans.
Okay, so we've got student loans, personal loans, and credit cards.
Yes.
And, I think it was one of the stats that we pulled for this episode.
Mhm.
There are over 20 million personal loan borrowers in the U.S. alone.
Wow. That's a lot.
That's a lot of people going this unsecured route.
It is.
What is driving
Yeah.
that popularity?
That's a really good question. And I think part of the answer lies in the rising popularity of debt consolidation using personal loans.
Okay.
So imagine you're juggling multiple credit cards
Mm-hmm.
with high interest rates.
Yeah.
You're struggling to make the minimum payments each month,
Right.
and it feels like you're barely making a dent in that overall debt.
You've been there. It can feel like you're on a financial treadmill, like just going nowhere fast.
Exactly. And that's where a personal loan can be a game changer for some people.
Okay.
You can potentially consolidate all that high interest credit card debt
Mm-hmm.
into a single personal loan
Right.
with a lower interest rate.
So instead of making all these different payments with all these different interest rates,
Yes.
I could just have one payment
Right.
that's potentially at a lower rate.
Exactly.
That sounds pretty appealing.
It can be, but it's crucial to remember that debt consolidation isn't a magic bullet.
Right.
It's not a quick fix.
Of course not.
It requires careful planning discipline and a commitment to managing your finances responsibly.
This isn't about just shifting the debt around.
No.
This is about creating a plan to get out of debt.
Exactly.
So I think this is a good place to maybe pause for now.
Okay.
We've covered a lot of ground in this first part
We have.
of our deep dive.
Mhm.
And I think it's important to let all this information sink in
It is.
before we go any further.
I agree. We've laid the foundation. Now it's time to build upon it.
So join us for part 2, where we'll unpack the crucial factors to consider before taking out any type of loan.
Yes.
We'll delve into interest rates, repayment terms, and some of the potential pitfalls to avoid.
It's going to be good.
You won't want to miss it.
You won't.
Welcome back.
Yeah.
I hope you are ready for round 2
Yeah.
of our deep dive into loans.
Yes.
We've laid the groundwork by explaining the difference between secured and unsecured loans.
Okay.
Now we're going to delve into some critical things you need to consider
All right.
before signing on the dotted line
Yeah.
for any loan.
That's right.
Whether you're eyeing a mortgage for your dream home or considering a personal loan to consolidate debt,
Uh-huh.
there are some universal truths
Right.
that apply to all types of borrowing.
Yeah.
And the first one that springs to mind for me is interest rates.
Oh.
Those
yeah.
little numbers,
Yeah.
that can make a big difference
They sure can.
in the long run.
Yes.
Can you break it down for us?
Sure.
What are the key things to understand about interest rates?
Well, interest rates represent the cost of borrowing money.
Okay.
It's essentially the fee you pay the lender for the privilege of using their funds.
So like the rent you pay on the money that you've borrowed.
Think of it that way. Yeah.
Okay, that makes sense.
Yeah.
But how do interest rates actually work?
Hmm.
Is it just one fixed number?
It can be, but it can also be a bit more complex than that.
Okay.
You've got fixed interest rates, which stay the same for the entire life of the loan,
Right.
providing predictability.
Uh-huh.
Then you've got variable interest rates, which can fluctuate over time based on market conditions.
So with the variable interest rate, there's a bit more uncertainty.
There is, yeah, there's a bit more risk because your payments could go up.
Right, if interest rates rise.
Exactly.
Okay, so are there any general rules of thumb
Yeah.
when it comes to interest rates?
Uh-huh.
Like, do secured loans usually have lower rates
They do.
than unsecured loans?
They do, yes, that's generally true.
Okay.
Secured loans tend to have lower interest rates
Hmm.
because they pose less risk to the lender.
Okay.
The lender has that collateral safety net,
Right.
that asset they can seize if you default.
Uh-huh.
This makes them more willing to offer more favorable interest rates.
So if I'm putting up my house as collateral for a mortgage,
Right.
the bank is more likely to give me a lower interest rate
That's right.
because they know that if I don't make those payments, they can take my house
That's right.
and recoup their losses.
Exactly.
But with unsecured loans,
Yeah.
where there's no collateral,
Yeah.
the lender is taking on more risk,
More risk.
and that's reflected
Mhm.
in the typically higher interest rates.
That's right. It's all about balancing risk and reward for both the borrower and the lender.
So true, so true.
Yeah.
Now, another thing that can really impact the overall cost of a loan is the repayment term.
Yes, absolutely.
Can you talk a bit about that?
Of course. The repayment term is the length of time you have to repay the loan.
Okay.
It can range from a few months for a short-term personal loan to 30 years for a mortgage.
Wow, that's a big range.
It is a big range, and the length of that repayment term has a direct impact on your monthly payments and the total amount of interest you'll pay over the life of the loan.
So let me see if I've got this straight.
Okay?
Shorter repayment term.
Yep.
Higher monthly payments.
Yes,
But I pay less interest overall.
that's right.
because I'm paying off that debt faster.
Exactly.
Longer repayment term, lower monthly payments,
Yes.
but I'm paying more interest over time because that debt is hanging around longer.
You got it. It's a classic trade-off.
Right.
You need to weigh your short-term cash flow needs
Mhm.
against your long-term financial goals.
So if I can handle those higher monthly payments,
Yeah.
a shorter repayment term might save me money in the long run.
That's right.
But if I need to keep those monthly payments lower,
Mm-hmm.
maybe a longer repayment term is better for my budget,
It might be, yeah.
even if it means I pay more interest over time.
That's right.
Okay, so there's no one-size-fits-all answer.
No, not at all.
It all depends
It all depends.
on my individual circumstances and goals.
Exactly.
Okay, so we've talked about interest rates and repayment terms,
Mm-hmm.
but there's another aspect of loans I think we need to address:
Okay.
fees.
Oh, yeah.
Sometimes it feels like loans come with a whole menu
They do.
of hidden fees.
Yeah.
Can you shed some light on that?
You're absolutely right.
Yeah.
Fees can be a sneaky way to increase the overall cost of a loan. So it's crucial to read the fine print and understand all the potential fees
Yeah.
before you commit.
Okay.
Some common fees you might encounter include origination fees, application fees, late payment fees, and prepayment penalties.
That's a lot of potential fees.
It is a lot.
It's easy to see how those could add up
Yeah,
and make the loan a lot more expensive
that's right.
than you initially thought.
Yes.
Any tips on how to navigate this fee minefield?
Well, first and foremost, don't be afraid to ask questions.
Okay.
If a lender mentions a fee you don't understand,
Mm-hmm.
ask for clarification.
Okay.
A reputable lender should be transparent
Right.
about all fees associated with the loan.
So knowledge is power.
It is.
Understanding those fees is essential
Absolutely.
for making informed decisions.
Yes. And don't hesitate to shop around
Okay.
and compare loan offers from different lenders.
Right.
Don't just settle for the first loan you're offered.
Good advice.
Take your time, do your research, and find the loan that best suits your needs and your financial situation.
All right, shifting gears a bit, let's go back to the topic of secured loans.
Okay.
And dive into an aspect we touched on earlier.
Yeah.
Lands.
Okay.
You mentioned that when you take out a secured loan, the lender places a lien
They do.
on the asset that you're using as collateral.
That's right.
Can you explain what that means in
A
plain English?
lien is essentially a legal claim
Okay.
that gives the lender a right to your property
Mm-hmm.
if you default on the loan.
Okay.
It's a way for the lender to protect their investment.
So it's like a little legal sticky note on my house or my car
Yeah, think of it that way.
that says, hey, we have a claim on this if things go south.
A great way to visualize it.
And while that lien is in place,
Yeah,
it can affect your ability to sell or refinance the property.
that's right.
So if I have a mortgage on my house
Uh-huh.
and I decide to sell it,
Yeah.
I'm going to have to pay off that mortgage
Yeah.
as part of the sale process
Yes.
to remove that lien.
That's right.
Okay. So linens are an important aspect
They are.
of secured loans.
Yes.
And it's essential to be aware
Yes.
of their implications.
It is.
We've covered a lot of ground here. Interest rates,
We have.
repayment terms, fees, linen.
About to digest.
It's a lot to digest.
It is.
But I think it's so important to have a good grasp of these concepts
I agree.
before you even consider
Yes.
taking out a loan.
Absolutely. An informed borrower is an empowered borrower.
Well said.
Yeah.
So join us for part 3 of our deep dive,
Right.
where we'll explore some real-life scenarios
Yes.
and help you decide which type of loan might be the best fit
Okay.
for your needs. Welcome back to the final part of our deep dive into the world of loans. It feels like we've covered so much
Oh, you have.
about secured and unsecured loans,
Yeah.
from collateral to interest rates to repayment terms to those pesky fees.
We have all the things.
But now comes the really interesting part, putting all of this knowledge into practice.
Right.
So let's shift gears a bit
Okay.
and talk about how to actually choose
Yeah.
the right type of loan
Mm-hmm.
for your needs.
Okay. Sounds good.
Okay, so let's say I'm in the market for a new car.
All right.
I've got my eye on a shiny new electric vehicle,
Nice.
but my current ride is on its last legs. What are my loan options?
Well, in this case, a secured loan,
Okay.
specifically an auto loan, is the most common route for financing a car.
So I'd be using the car itself as collateral.
Exactly. You got it.
So if I miss payments, the lender could repossess my shiny new electric vehicle.
Yeah, that's a possibility. Nobody wants to think about that.
Not really, no.
But it's an important reality to consider with any secured loan.
It's the risk you take, right?
That's right.
Okay, so Let's say I'm not in the market for a new car.
All right.
Instead, I'm dealing with some lingering credit card debt.
Okay.
I'm making the minimum payments each month,
Yeah.
but it feels like I'm barely making a dent
I see.
in the total balance.
Yeah, that's where an unsecured personal loan might be a good option to explore.
Okay,
As we talked about earlier, personal loans are increasingly popular for debt consolidation.
right.
You could potentially consolidate all that high-interest credit card debt into a single personal loan with a lower interest rate.
Okay, so instead of juggling multiple credit card payments
Mm-hmm.
with all those different interest rates,
Yeah,
I could just have one payment
exactly.
that's potentially at a lower rate,
Right.
and that could help me get out of debt faster.
It could, but it's important to shop around,
Okay,
compare offers from different lenders to make sure you're getting the best possible terms.
great advice. One more scenario for you.
Right.
Let's say I'm a recent college grad,
Okay.
staring down a mountain of student loan debt.
Yeah, a question a lot of people are facing these days.
It is.
Student loans can be a heavy burden,
They can be.
but there are options.
Okay.
Refinancing your student loans is a strategy you might consider.
Okay, so that's kind of like a debt consolidation,
Exactly.
but specifically for my student loans.
That's right. And if you have a good credit score and a steady income,
Hmm.
you might be able to qualify for a lower interest rate on a refinanced loan.
Which would save me money over the life of the loan.
Exactly. So it could be a win-win.
Lower interest rates, possibly lower monthly payments.
Potentially sounds
Yeah.
good. But just like any other financial decision, it's important to do your research.
Right.
Understand the potential risks and benefits before you jump in.
I think that's the key takeaway here.
Yeah.
There's no one-size-fits-all answer
Right.
when it comes to loans.
What's right for one person might not be right for another.
It all depends on my individual circumstances,
Absolutely.
my financial goals,
Yes.
and my risk tolerance.
That's right. We've explored a lot of factors to consider here.
We have.
Interest rates, repayment terms, fees, collateral, your credit history.
It's a lot.
It's a lot to keep in mind.
It is. But, understanding these concepts can empower you to make smarter borrowing decisions.
Absolutely.
Knowledge is power, right?
It is.
The more you know about loans,
Yep.
the better equipped you'll be to navigate the world of finance
I agree.
and make choices that align with your goals.
I couldn't have said it better myself.
Well, thank you for joining us for this deep dive into the world of loans.
Yes. Thank you.
We hope you learned some valuable insights
Yeah.
to help you navigate your own financial journey
Absolutely.
with confidence.
Until next time.